you spent a good part of the year writing about how tech has gotten more expensive. That hasn't changed, obviously. So what does that mean for 2020 in terms of playbooks?
Well, I think really our observation is that both tech is more expensive, and particularly for high-priced tech stocks, expectations are high. Now, that means there's just more risk in the sector. Structurally, tech is a stronger growing sector. Quality indices for tech are pretty high. Return on invested capital metrics, cash flow metrics are very strong for tech, but you're fully paying for that. And expectations in terms of 5-year growth rate for tech is very, very high relative to history. So our observation is tech is riskier today. There's been huge multiple expansion in the sector this year. And so investors need to balance that and be really selective. So we're advocating a market weight in tech, and we're advocating that investors focus on reasonably priced names that have high quality indices and be cautious about higher priced, higher valuation names. And we've seen this play out somewhat over the last 6 months with the rotation more towards value-oriented names. And we think investors should continue with that playbook.
How do you balance it, though, when investors are the bulls pound the table constantly saying there are secular stories that investors still don't get the potential of 5G, autonomy, cloud, right? And over time, those expectations have been fulfilled.
Look, that's the trillion-dollar question, quite frankly, which is there's a price for everything. And we do hear from investors, look, there are new cloud models that are quite different from what existed 10 and 15 years ago that allow for higher levels of free cash flow and greater sustainability. And our point is that may be the case, but you're likely paying for that. Tech valuations on a relative basis and absolute basis are at 15-year highs. Tech has outperformed the market for 7 straight years. In the last 3 years, all of the outperformance has been driven by multiple expansion. In the first 4 years of those 7 years, it was all by superior earnings growth. But the last 3 years, it's really been multiple expansion. And so, look, I think it's too tough to say this is going to reverse because there is better structural growth in tech. I think investors just need to be aware that they're really paying for that now. They're paying at elevated multiples. And so in constructing a technology portfolio, we would err on trying to find high-quality names with more reasonable valuations.